Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. I'm super excited to have you guys here, and that's simply because in this week's episode, we are going to be talking about how to use moving averages properly. Okay, a lot of traders, moving averages are one of the most underrated technical indicators out there because a lot of traders feel that since they're basically free, you can find them on almost any chatting platform. They may not, be all that valuable and all of that kind of jazz, but that's actually far from the truth because moving averages, they're very dear to me because one of the strategies that I used to become profitable in the early stages of my trading when I was just struggling to have things work out was a strategy that involved the use of moving averages. I have mentioned it a couple of times on this channel, lots of times actually, not even a couple of times. So it's basically a trend trading strategy that uses moving averages for multiple time frame analysis and then looking for low risk high probability trade entries and exits and all of that. So moving averages are very dear to me, okay, because I found them to really work for me. But with that said, there's actually a right and a wrong way to use moving averages. And that's one of the reasons why I chose this week's topic to talk about moving averages, okay? So that you know the right way to use it and the way to avoid using it, like all of the traders, the rookie traders who don't know how to use it well and keep making mistakes with it, okay? So without wasting any more of your precious time, let's dive right into it, okay? So first things first, what exactly are moving averages? Okay, so to help you understand this, let me give you an analogy, an explanation, let me dumb it down a little bit, okay? So moving averages, or before we even talk about moving averages, let's talk about averages, in the root sense of the word. So when you say something, you have an average of something, you're actually taking the bits and pieces of data that you have about that thing, and then you're dividing it by the number of, data pieces or whatever you have to get the average of that thing. So let's assume you're a class teacher, for example, and you've got, let's say, 5 students in your class, the class that you're taking. Okay, this is just an example. Or to make it more realistic, let's just say you have something like 10 students in your class taking your subject. Okay, now let's say those 10 students, they actually took a test that you gave them, and then just as it is with a regular class, some of them passed and some of them failed. Some of them, their scores were just wildly different all over the place. Okay, so if you wanted to get the average score of the students in your class, what you would do in this case is you'd add up their scores across the board. And since in this particular example, we're using a data set of 10 students, so you're going to add up their entire scores, every individual student score, you're going to add it up, and then you divide it by the number of students in the class. Okay, so you add up their score number 1 score plus score number 2, score number 3. My handwriting is awful here, so I know. So score number 1 down to score number n, okay, the nth score. And then you divide it by the number of students in the class, which in this case is going to be 10. Okay, so the resulting number that you get is going to be termed the average score of the students in your class. Okay, so this is how we get an average of anything. Now, when we talk about moving averages in the financial market, it's really no different. The only difference between an average score, just like the one I gave you an example of, and the average of the average price of an instrument in the financial market is that because as more and more candles keep forming, or bars, or whatever the type of charting platform you're using for analyzing your price action, as more and more of those candles or bars or whatever the case might be keeps forming while the market is opening, while the market is open, printing the prices of the instrument, whenever a new data point is taken and then the previous data points are added to work out what the current average of that particular instrument is, then whenever that happens, we're going to have a new average, and the charting platform is automatically going to plot those averages for you as time goes by. And that's why it's called a moving average. Because to give you a brief example of this, assuming you were using an exponential moving average. Okay, in this case, let's say you're using it with the period set to 50. Now, what this charting platform will do is, in this case, if you set the price for the calculation to be the closing price of that particular instrument, then at the close of, if you're using 60 as a period, like I told you earlier, let's say the last 50 candles that you have here, if you're using 50, sorry, let's use 50 to make it easy, not 60 here, okay? It doesn't even matter the number of period you're using. It's just to make the explanation easier for me. That's why I'm using it, okay? So if you're using a 50 period exponential moving average applied, and you're using the closing price of that particular instrument on the charts that you're analyzing to calculate what the average is, this simply means that on the charts that you're analyzing, the instrument, the moving average, the charting platform is actually going to take the closing price for the last 50 candles, and then it's going to sum all of them up and divide them by 50, because we are using 50 periods in this example. And then the average resulting price that it's going to get is going to be printed on the chart. And as new candles form or new bars form, then the platform is going to continue printing those and then connecting it with a line. And that's why you'd see a line on your chart when you plot the moving average. And because it's called a moving average, because as new data is formed on the chart is going to be plotting that line and keep moving. It's going to keep moving, and printing it. Okay, so enough of the theory now. I'm pretty sure you would have gotten the logic behind it. Okay, let's quickly add a moving average for the chart. Okay, so let's add the one that we just used as an example now. We're adding, let's say, a 50 period exponential moving average. So in order to do that, if you're using the MetaTrader platform, this is MetaTrader 5, okay? So if you're using the MetaTrader trading platform, all you need to do is hover your mouse's cursor on the navigator bar and then take it onto the Inserts tab on the navigation bar, okay? And then hover your mouse's cursor over the Indicators tab. And then, since moving averages are under the category of trend indicators, trend technical indicators, then you're going to hover your mouse's cursor over the trend technical indicators category, and then you'd see moving averages somewhere around here. Okay? Once you see it there, just click on moving average, and then once you've done that, in this parameters field that you're seeing here, you're going to type in the number of the period that you want. Remember, I told you earlier it was 60 periods. It doesn't really matter. 60, 50, 100, whatever period you're using, just type that in here. And what this period simply means is that how far back do you want the indicator to go to get the data for the whatever moving average you want it to plot on your chart. So if you want it to go back as far as the past 100 candles, for example, then you're going to type 100 period here, 100. But for this example, we're just using a simple setup, a 50 period exponential moving average, and we're applying it to the closing price. If you want, you could use, when we say apply to, that simply means that you're using the closing price for the calculation. Okay, if you used the open, this would mean that the trading platform is going to take the opening price of the past 50 candles, and then when it takes those opening price of the past 50 candles, then it's going to add them up together. And then after adding them up, it's going to now plot the line on your chart. Okay, that's simply what it means. Okay, so let's use the closing price because this is what is most common in the markets. Okay, so a 50 period simple moving exponential moving average. If you want it to be a simple moving average, you can choose that here. If you want it to be exponential, choose that here. Smoothed, linear weighted, whatever you want to choose the type of moving average, you just select it here. Okay, and then shift is if you wanted to, the line to be shifted into the future a little bit, but you don't really need that. It's it's just a kind of a setting that you wouldn't need right now. Okay, so we're just keeping things very simple here. So the color, you could choose to color it whatever you want. I'm just going to go with the blue color, and then the lines, I'm going to select this one to make it a little bit thick and to stand out on the charts, basically. Okay, so once you've done all of these settings, if you wanted your moving average to kind of show only on a certain time frame and not on other time frames, this is where you're going to do all of those settings. But I don't think we really need to do that now, so we'll just click on OK, and that's exactly what you're seeing on our charts here. you can see that this is a 50 period moving average. And this simply means that the chart that you're seeing here, the trading platform took the reading, the closing price reading of the past 50 candles, and then it kept plotting their average over and over again until we had this trading platform connecting those averages with this line, and that's what it looks like here. Now, there are some traders use a single moving average. It's not too often that I see traders doing that actually, but some traders use just a single moving average. Some use two, some use three, depending on however you want to use it, because there are lots of ways to use the moving averages, okay, to define what the direction of the trend is. So for some traders, they'll just use one moving average, and if price is trading below the moving average, then they would consider the direction of the trend to be bearish. And if price is trading above that moving average, they would consider the direction of the trend to be bullish, okay? While other traders used a combination of moving averages. So the one that I'm more familiar with, that I've seen a lot of traders use in this case, would be something like using the 100 period moving average, 200 period moving average, and the 50 period moving average. So let's quickly add those to the chart so that I'll show you what it looks like. Okay, so again, just like we added this 50 period moving average earlier on, just go to the navigator bar, hover your mouse's cursor over the inserts tab, and then indicators category of technical indicators, then the trend category of technical indicators, and then click on moving average. Next up, we're going to be adding a 100 period exponential moving average, and then we're going to just color it black. Click OK, and we have it on our charts. Then the third one that we're going to be adding to the charts now is, another moving average, exponential moving average, but this one's going to be a 200 period exponential moving average, and we're going to use a red color for this. Okay, and just click on OK. So this is what it looks like. Now, for traders who use this method or this triple moving average setup to determine the direction of the trend and to find trade setups and all of that, there's what we refer to in trading as the proper order. So what the proper order simply means is that ideally, for you to be able to determine or define the direction of a trend, you want to see them in the proper order, the moving averages in the proper order. And in this case, what is the proper order for a downtrending market? The proper order for a downtrending market will be the 50, that's price being below the 50 period moving average, which is the blue line here. And then the blue line being below the 100 periods exponential moving average, which is the black line here. And then the black line being below the 200 period exponential moving average, which is the red line here. So in this case, as long as price is below the moving averages, and then the blue one is below the black one, and the black one is below the red one, in that order, then that is the proper order for a bearish trending market. On the flip side, the proper order for a bullish trending market is you want to see the blue moving average being above first of all, you want to see price being above the blue moving average, and the blue moving average being above the black one, and the black one being above the red one. In that case, you consider the market that you're looking at for that particular case to be a bullish trending market. Okay, so you can see this, you can see it clearly here. Price was above this, the blue was above the black, and the black was above the red. This was a bullish market. And consequently, since this was a bullish market in this case, you can see that the market structure of an uptrending market was what was just kept forming. So price was just forming highs, higher low, higher highs and higher lows, higher highs, higher lows, higher continuously. But again, like we talk about this in almost all of the classes that we talk about market structure, no matter how strong a trend is, that trend does not last forever. Eventually, price is going to find it difficult to continue forming higher highs and higher lows. And then eventually it's going to fall and break below the lower high. And then there's going to be a switch in the direction of the trend. Whether if it's temporary or, indefinitely, that's going to happen at some point in the trend's life. Okay? So now that you understand the proper order and how some traders use them, moving averages to do that, what is the proper way, which is basically what today's class is all about? What is the proper way to use moving averages? And for this, I would like to take you back to one of the things that I just showed you when I was adding the moving averages onto the chart that you might have even overlooked. And that's the fact that even in the trading platform that you're using. In this case, let's assume you're also using MetaTrader like I am. You would notice that when you go to add the moving average onto your chart, it's actually classed or categorized under the category of trend indicators, technical indicators, because the moving average is actually used mainly by professional traders to either identify the trend or trade when there's actually a trend in the market. Okay? And so when you try to use the moving average in the market where there's no trend, you're actually going to find it more difficult to find winning trading opportunities in that situation. So the proper way to use moving averages is to use them when there's a trend in the market. And how do we know that there's a trend in the market? We don't just, if you want to go a little bit pro, okay, to make it a little bit advanced, then you would want to consider market structure, which we've talked about on the channel multiple times. Because the simple way that most beginners would just use to identify the direction of the trend with moving averages is to simply say that, okay, if the moving average, if price is below the moving averages, then we're in a downtrend. And if price is above the moving averages, then we're in an uptrend, which there's nothing bad with that. But just because price is below a moving average or is above a moving average does not mean that we're necessarily in a trend, because we could have consolidation price action or ranging price action, and then price could still be either above or below the moving averages. And when you trade with that mindset, you're only trading with a moving average, because price is above the moving average because you think it's bullish, then if the market is not trending, you're actually going to take a lot of losses or whipsaws or false positives or false breakout trades when that happens. And so for you to really trade when there's a trend in the market, you want to couple using moving averages in the proper alignment or in the proper alignment, which I just explained to you earlier on, along with market structure. So let me show you exactly what I'm talking about, okay? So for somebody who is just trading based on, price is below a moving average, the direction of the trend is bearish, or price is above a moving average, the direction of the trend is bullish. Someone might consider when price did this crossover, when this blue moving average was trading below the black one and the black one was trading below the red one and price was below all of them, then at this point in time, you would consider, okay, that the direction of the trend is bearish. Okay? Now at this point, for somebody, let's say when this trend alignment happened, it was somewhere around here. Okay, now for someone, you would consider that, okay, anything after this, then you'd consider it to be a downtrending situation which you'd want to take advantage of. Which in this case, if you had seen this and then you would have noticed that prior to this, price was forming lower lows and lower highs, lower lows, and eventually we had the proper alignment here. So let's say you saw this, and then all of a sudden you saw that, okay, the market structure was the market structure of a downtrending market because price was forming lower lows and lower highs, which is one confluence. And then the second thing is that the blue moving average is below the black one and the black one is below the red one. So the faster one is below the medium term one and it's below the slow one. So we are definitely in a downtrending market and market structure agrees with that. So let's say after you've seen this, you saw the formation of this price rejection candlestick at this correction center, okay? And then you saw the formation of this bearish engulfing candlestick. You could have easily taken a short trading opportunity here, short trading position here, which, let me quickly do this. You could have easily taken a short trading position here with your stop loss being above here. And if you're going for a 1:2 risk to reward ratio, this would have been a good winning trade for you right after you took it within the same day. So this is one way to couple them together to take a trade. Okay, now this would have been a winning trade for you. But then, if this was all you did, okay, if this was the only way you determined when to take a trade, that means when price is just below the moving averages, you just take the trade without paying attention to market structure, then guess what would have happened here? You would have seen that, okay, maybe after you took this trade and it hit your profit target, then you would have seen that, okay, price is still, below here, it broke below this support, and then now you want to take another trade. But then, after you would have taken the trade, you would have noticed that price is struggling to break below this level. And so if you are taking a short trade here with a stop loss here, aiming for a 1:2, price would just have moved like 1 hour in profit, and then it would have come back to stop you out. This doesn't mean that just because this happened, that when you use the other technique, you're always going to get a 100% win rate. No, but there's a confluence that you would look at that would improve your win rate and your probability of taking those winning trades. So you don't just want to take a trade in the direction of the trend just because price is below a moving average or whatever. You want to couple that with the knowledge of market structure. And one of the things you'd notice is that the trend was intact as long as price was forming lower lows and lower highs. But then all of a sudden, price formed a lower high, but then it was struggling to break below this lower low. Okay, so we had something like a double bottom here. And if you were paying attention to market structure, this would have been a warning signal for you that maybe the trend is temporarily not continuing that side. And so you'd have seen that price broke above this resistance. So we went from forming lower lows and lower highs to now price forming higher highs and temporarily higher lows. Okay, so as long as price doesn't break this level, we're still in a downtrend technically, but price could break below this level. So you don't just want to use price being either above or below a moving average to take a trade setup. You want to couple that with the fact that, okay, there's market structure or we are at resistance or support or things like that, okay, to improve your the probability of your trades actually giving you an outcome that you are pleased with, okay? So moving on. Now, remember when I told you that moving averages are basically indicators that were designed primarily to be used within trending market environments? And I told you that just using a moving average or just saying that price is either above or below a moving average to determine the direction of the trend for you to trade in does not really work like that, or that's an improper way to use moving averages. Well, that's exactly what I want you to pay attention to on the charts right now, because as you can see, price has been above the blue moving average, and the blue moving average has been above the black one, which is the 100 moving average, 100 period moving average, and the black one has been above the red one. So technically, we are in an uptrend. And this was all fine and good as long as price was forming the market structure of an uptrending market. So we went from forming lower lows and lower highs, lower lows and lower highs, but this is technically a higher low because it broke above this resistance. And so now price has switched from forming lower lows and lower highs to now forming higher highs and higher lows. So this market structure change preceded the moving average falling in the right proper alignment, okay, for a bullish trending market. So technically, when price was forming these higher highs and higher lows, and then we had these moving averages in the proper alignment, okay, at this particular point, yes, the market was in an uptrend, and it was all good for us to take long trade setups, okay? So as long as this was intact, we were technically in an uptrending market, okay? But then, remember, I told you that you want to couple market structure with the direction of price in relation to the moving averages when you're determining the direction of the trend for you to take trade setups in the direction of that trend. Now, when you take a look at this chart, you notice that in and around this price region, price now stopped forming higher highs and higher lows, and it was basically struggling. So it formed this high, and then it formed this low. But then it was struggling to form a high which is higher than this previous high. So it formed a lower high. And then it formed a low which is actually lower than this previous higher low, which technically now we are no longer forming higher highs and higher lows, which is the market structure, you know, the typical anatomy of a market structure for an uptrending market. And we've switched to forming lower lows and lower highs. And this is not what we want to see. Okay, so if you went with the fact that, okay, I'm just trading, you know, taking long trades here because price is above the moving averages and then they are in the proper order, then you would have taken a lot of losing trades here because price in this region was just ranging. Okay, it just kept bouncing between these levels of horizontal support and resistance. And you can see that clearly just buying or selling because price is either above or below a moving average without paying attention to market structure is not the right way to do these things. Okay, so ideally, if you want to take a trade in the direction of the trend using moving averages, you also want market structure to agree with you. Okay, so if price is technically forming higher highs and higher lows, then you'd want to wait for a retracement, and then you want the moving averages to be in the proper order, and that will increase the probability of your trades to hit their profit targets because we are technically in the trending market. But even if price was above a moving average and the moving averages were in the proper order, but market structure is not agreeing with what the direction of the trend is saying by the moving averages, then you're going to take a lot of losing trades, because moving averages were not designed to be used for trading during ranging market conditions or consolidating market conditions. Okay, so this is the proper way to use moving averages. You want to use them to identify trading opportunities when the market is trending, and not when the market is ranging. That's the improper way to use them. In fact, you could, just like I showed you, even in the trading platform, they showed you that the way they categorized moving averages as a technical indicator is under the trend category of technical indicators, because that's basically what they are used to trade best with. Okay, their ideal or optimal trading environment is trending markets. Okay, so this pretty much brings us to the end of this week's edition of the ITU Forex class. But again, before we wrap up the class, I would like to use this opportunity to invite you guys to test out our suite of ITU bots, which are robots or expert advisors designed to look for low risk, high probability trading opportunities on your behalf, and then place those trades for you with proper risk management and get you earning while you're learning how to trade. Okay, so you could diversify your portfolio, a portion of it to automated trading and a portion to manual trading, which is what we teach you how to do properly in the ITU Forex classes. Okay, so if you're interested, please reach out to us and we'll show you everything, how to set everything up step by step, as soon as we can, as soon as we reach out to us on any one of our social media handles. Once again, I sincerely hope you got value out of today's class, because this is one of the things that a lot of traders don't, especially traders who are struggling to become consistently profitable. A lot of them don't know how to use them. It's just like, I want to trade and then I use an indicator and I just use them blindly whenever I see price either doing this or that. There are nuances to these things, okay? So please pay attention to them, and I look forward to seeing you guys in next week's edition of the class. Once again, have a wonderful rest of your week and go out there and crush the markets, okay? Cheers and God bless you.